Hello, everybody, and welcome to Sense of Security. Today, we are going to talk about the international outlook with Russell Burns from Finimize. Welcome, Russell. How are you?
Hey, hi, Mary. I'm really good, thanks. Looking forward to this.
Yeah, me too. Okay, so let's just go right into it. So, from a global perspective, what were the three biggest surprises you found in 2025 for investors, and how do those set the stage for international markets this coming year?
Yeah, thanks, Mary. So I'm going to measure the surprises by the size of market moves. So first up, I'm going to go with the president's tariffs announcements on Liberation Day. That initially scared equity investors as there were fears it would cause a global economic slowdown and inflationary pressures. And then we saw a sharp reversal back up as the tariffs were watered down, the realization that the inflationary pressures weren't going to be so bad, and the US economy managed to hold up much better than feared. Next up, the strong move in precious metals. Gold's near 65% rally and silver's 147% were quite astonishing. Well, the reasons cited include increased geopolitical risks, concern about the independence of the Federal Reserve, uncontrolled government spending, undermining the value of fiat currency, and a shift towards real assets. And then third up, I'm going for international stock indexes, generally outperform US ones. That's the first time in some years that diversification outside of the US really rewarded investors. And why has this finally happened? Well, you had the weak dollar, which dropped around 10% against a basket of currencies, the first time it had really come under pressure like that in more than a decade. Valuations finally counted. Greece, Spain, and Poland led European stock markets. And the realization that it's not only in the US where AI beneficiaries were found. Taiwan was led by the heavyweight TSMC, and Korea not only by its cheap valuations, but its exposure to the memory makers, major AI beneficiaries, alongside a corporate reform program, which drove a 75% return in the index, second only behind Colombia. And looking into 2026, most of these factors still remain relevant. The year started off with increased geopolitical risk and tariff threats, and that uncertainty remains supportive for precious metals. And there's still talk of lower interest rates in the US, despite higher than targeted inflation. And that could pressure the dollar further. And if that happens, it's another reason for international stocks to do well once again.
Yeah, good point. How are the key macro forces, growth, inflation, and central bank policy, diverging between the US and major Asian economies?
According to Goldman Sachs, global real GDP is expected to be about 2.8%. The US is kind of leader of developed markets at 2.8%. The Eurozone and UK is about 1.4%, and Japan at 1.2%. In the emerging markets, China with its 5% growth and India's 7.6% are leading. India's going to post the strongest growth, but it's got the highest inflation and interest rates, and its stocks trade at higher valuations too. China's 5% growth is pretty much all export led, as the domestic economy remains weak. When we look at earnings growth, which is a key driver of stocks, it's a slightly different picture. S&P 500 earnings are expected to grow around 12% in 26. Europe, stock 600, 5%. Japan, 9%. As for inflation, it's pretty much contained in Europe. It's sitting around its 2% target. And no rate cuts are expected from its central bank in 2026. It has cut 8 times since the pandemic, and interest rates are sitting already around 2%. Despite inflation running ahead in the US, we have seen rate cuts already, as the Fed's been focusing on the employment part of its mandate. But we've got a new Fed governor starting his role sort of later this year, and he's likely, or she's likely to be more attuned to the president's thinking. So expectations are for more rate cuts this year. Japan's different. Its inflation is running hot. It's exceeded its 2% target for nearly 4 years, and its interest rates are only at 0.75%. It's, as ever, a pretty unique case. Japan hiked rates in 2025, and it's currently the only central bank among major developed countries expected to hike again in 26. So, looking for an advantage from the macro perspective, earnings growth in the US continues to deliver, and that's attractive. It remains the global tech leader. And with more rate cuts expected, that should be supportive for stocks. But alongside all the uncertainty and geopolitical risk, a diverse portfolio across regions and assets does seem sensible. And that should likely include some Japan, Europe, and emerging market exposure. Personally, outside the major emerging markets, I quite like Korea. It's got a corporate reform program and memory exposure. And India's stocks do look expensive, but they have little AI exposure, so it could act as a diversifier as well.
All right. So for newer investors trying to go global, how should they think about the impact of currency moves, or should they, and interest rate differentials on international returns? Any surprise rules of thumb to avoid some common pitfalls?
You also say, should they? And that really is an important one.
Yeah.
Currencies are notoriously hard to predict, even for the pros. You should be aware that FX fees on certain brokerage platforms can be really uncompetitive. Not IBKRs, mind you, but it's really something you have to be aware of when investing in international stocks. Those high charges can seriously undermine returns. One way to avoid FX transaction costs is by using ETFs or funds. You can find many country and sector ETFs that are based in a variety of currencies. So depending on your own base currency, you should be able to find a suitable one. And that's the easiest way to deal with FX transaction costs, is that ETF and fund providers can trade at a much more competitive bid-offer spread than you can. As for interest rate differentials, it's probably good to know some macro basics like what the interest and inflation rates are in the countries you plan to invest in. But unless you're planning on trading FX or foreign bonds, I wouldn't worry too much about the rate differential. Saying all that, currency moves can have a serious impact on investment returns. Last year, we mentioned that the US dollar fell about 10%, one of its worst performances in a decade. And that bumped up returns of international stocks for US investors if they'd invested on a so-called unhedged basis, i.e. taking on that FX risk. But as some of those drivers from 2025 still look like they're present in 2026, we could see more of the same. Still, if you wanted to invest overseas on a hedge basis, i.e. taking away any of the FX risk, many of those ETFs and funds do that too. ETFs are so clever these days with so many different providers. And that way, whether the currency moves or not, you can just get exposure to the underlying price move. There's another perspective for advanced traders. You could look to trade international stocks on margin, i.e. borrowing, and that protects you from the FX risk, although that would involve borrowing costs.
Really good points there. Okay, so where do you see the most compelling opportunities and biggest risk in emerging markets versus developed markets this year?
Yeah. So let's first consider the two big emerging markets, China and India. China's progress on AI and robotics is impressive. But as I mentioned, the domestic economy continues to struggle, and its 5% growth comes mainly from exports. So it's pretty difficult to be excited about its domestic market outside AI. But still, having some China AI and robotics exposure does look sensible. India's stocks have been lagging other markets over the past year, but it doesn't have that much AI exposure. So as I mentioned, it could act as an interesting diversifier. However, its currency continues to remain under pressure, even against the dollar. Personally, I'm looking at Korea. There's a really interesting corporate reform story driven by the new government, and its two biggest stocks, Samsung and SK Hynix, account for more than 40% of the index. And they were the key drivers of the Kospi, the main index, 75 performance in 2025. It's their exposure to memory that's seeing massive demand from AI servers, which is really boosting their profits. You may have seen Micron's rally. They basically have the same business. And if demand for memory remains strong through 2027, as expected, those stocks in the Korean market could have a really strong 26 too. For the developed market, we've already discussed the strong earnings growth in the US. As for developed markets, I've already discussed the strong earnings growth in the US, and it still accounts for 60% of the global stock market capitalization. Plus, we're seeing some rotation into the mid-caps in the US that should benefit from the domestic economic recovery and lower interest rates. And outside in the US, Japan and Europe and developed markets both look reasonable too. But as for the biggest risks, I'd like to highlight valuations are rich compared to history across all stock markets, right? If earnings keep going up, that should be fine. But if we see a slowdown, then those high valuations are really going to matter. AI remains a really big opportunity, but it's a big risk if AI demand and spending drop away. It's estimated that around half of global GDP is coming from AI spend. So any slowdown there is going to be impacting global stock markets. And of course, we've got geopolitical risks. Any escalation in trade wars or more invasions would upset markets again.
Looking at global sectors, including AI, are there any country or region standouts where those themes have the strongest policy or earnings tailwinds?
Yeah, AI spending continues to be the main driver of global growth. And it's not just tech companies that are benefiting from AI. These data centers require huge infrastructure to be built. There's demand for turbines, nuclear energy, electrical equipment, and water cooling equipment. AI is impacting copper demand too. Industrials are benefiting not only from the AI rollout, but also the onshoring of production in the US. And with regards to regions, as I touched, there's many regions benefiting from AI spend. With regards to regions from tech and AI, there's many beneficiaries. But there's a few other sectors worth noting as well. Defense. This uncertain geopolitical backdrop implies that spending on defense is going to stay. Again, you can find companies in the US, Europe, and Japan that are benefiting from this increased spending. One way you can play this is through a global defense ETF that provides broad-based exposure to the theme. And finally, you've got metals and mining. Copper demand's been picking up as well as precious metals. And finally, I think it's worth considering metals and mining. It's not just been gold and silver that have been moving higher. Copper's seeing a pickup in demand from this AI infrastructure spend. And that means global mining stocks could continue to perform well, especially if this move to real assets continues.
So, geopolitical tensions and supply chain realignments continue to reshape trade routes and CapEx decisions. Where might these dynamics create investable opportunities or hidden risk across the regions in 2026?
We've discussed uncertainty around geopolitics already, and it's really hard to know what's going to happen on so many fronts. But for sure, an escalating trade war would likely bring back fears about inflationary pressures and a weaker stock market. Still, I've already mentioned those global defense ETFs, but you could go a little bit niche and look at these drone stocks. The issue is that the valuations on these companies look a little bit rich. But supply chain realignment and onshoring is providing an investment boom. Reports suggest that TSMC is set to invest more than $200 billion into the US. These are massive amounts and massive inflows. It could be inflationary in the short term. TSMC has already said that manufacturing chips cost more in the US than in Asia due to higher labor and regulatory costs. But longer term, it could boost US growth and productivity. One of the bigger risks is that the new Fed chair is going to be willing to cut rates despite higher inflation, more in sync with the president's wishes. And that could lead to a weaker dollar and a continued rally in gold. That's why, despite its stellar rally in 2025, it probably still has a place in a portfolio. But the biggest risk that I can see would be, in light of increased geopolitical tension, China thinks it has the right to take over Taiwan. That would likely be a catastrophe for markets, as it still manufactures locally most of these advanced chips that AI needs.
Yes, I agree with that one. So, if we follow an investment calendar approach, what are the must watch global dates? Or some of them, 2026? Central bank meetings, elections, earnings seasons, or index rebalances? And how should beginners prepare around those events without over trading?
First up, if you're a beginner, actually trading around short-term events is difficult. Day trading is dominated by computers and AI algorithms that can typically interpret events and react quicker and more accurately than you can. So, as you said, not over trading is really important advice. However, if you do the preparation work before an announcement and have a view of what's likely to happen, then you can be positioned ahead of or take a trade after the announcement. Just be aware that the positioning of traders ahead of time is sometimes as important as the actual announcement itself. But what you really need to avoid is trading based on emotional decision making, as that usually doesn't end well. Investing with a longer term approach is easier and less taxing emotionally. However, with all that in mind, it is worth being aware of upcoming major events or announcements, as they're likely to help understand why markets are moving. And for sure, with that in mind, earning seasons are always important, especially for market leaders like Nvidia, which can set the tone for specific sectors for the following weeks and months. You're probably aware there's 4 quarterly earning seasons through the year in the US, and it's a similar in most other major markets. But be aware, it's not only the results that matter, but also the guidance or commentary from management that's more likely to move the share prices. So you'd have to listen into those calls. Interestingly, you can now use AI to download transcripts, and with the right prompts, it can interpret the call and outlook for you. But even then, if you get everything right, earnings beats and positive commentary can still see a stock sell off if too many short-term traders are already positioned anticipating them. Now, that can present an opportunity to buy a stock at a lower than warranted price, but you have to be really confident and prep beforehand. Aside from that bigger picture, elections can be important too. This year, I think there's 2 big ones to watch. In the US, we've got the midterms expected in November. And in Japan, there's a snap election expected to be announced next month. And the new Prime Minister's policies to lower taxes and increase spending have already caused bond market ruptures, as Japan's 40-year bond yield hit a record high earlier this week. Next up is central banks. What's really worth watching this year is there's a new Fed chair, and this person's likely to have different views about the suitable level of interest rates than the current one. So it's going to make these first meetings very closely watched. The second central bank probably worth watching is Japan's, in light of it's likely to be the only one hiking rates this year, and the potential impact not only on bond, but also stock markets and currencies. Finally, you've got the rebalances, the index rebalance you talked about. I mean, you've got 4 main events annually from MSCI and Russell indices. These are important events and can impact flows. I kind of like to be aware, if I can be, of the new entrants, exits, or the weighting changes once they're announced. But it's more to understand why share price in a company I'm following may be moving rather than necessarily trading around it.
Good. Russell Burns from Finimize, thank you so much. Excellent. Love it. Thank you so much for being with us today.
Thank you for having me, Mary.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.
Investments in certain commodities, precious metals, may be subject to significant price volatility and often involve risks related to market fluctuations, liquidity constraints, geopolitical events, and changes in global economic conditions that could adversely affect their value.
There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.
Mutual funds are investments that pool the funds of investors to purchase a range of securities to meet specified objectives, such as growth, income, or both. Investors are reminded to consider the various objectives, fees, and other risks associated with investing in mutual funds. Please read the prospectus accordingly. This communication is not to be construed as a recommendation, solicitation, or promotion of any specific fund or family of funds. Interactive Brokers may receive compensation from fund companies in connection with purchases and holdings of mutual fund shares. such compensation is paid out of the fund's assets. However, IBKR does not solicit you to invest in specific funds and does not recommend specific funds or any other products to you. For additional information, please view our mutual fund product listings. Trading on margin is only for experienced investors. With high risk tolerance, you may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest. Day trading can be extremely risky and may not be appropriate for individuals with limited resources, investment experience, or low risk tolerance. Please review the day trading risk disclosure statement before deciding whether day trading is appropriate for you.